Hello traders, Dan here, and in this trade review, let's talk about SG. Here's the daily chart. As you know at Master Trader, all option trading is based upon a bias on the underlying technicals. That's where we start, then we decide if we want a directional option trade or what we call income option trade, where we're just selling out of the money options or credit spreads to keep the money. The compelling pattern on SG here started on earnings. This was what we call a bullish professional gap. This stock was in a downtrend, lower lows, lower highs, declining 20 and 50. This was a bearish wide range bar, closing breakdown bar. That 100% communicated lower prices. Now it had earnings the next day. You can see the real body here. So the bottom of this green real body was the opening price, went down a little bit, and closed with a range expansion breakout bar. So it negated this downtrend, and on the closing of this bar, it became a sideways trend because it made a higher high here above this prior pivot. So everybody in this red bar is trapped. At the close of this bar, we gave it to our subscribers of the weekly options trader the next day over the high, where we said over this bar's high, we're going to sell a $20 put. And these were the only expirations they had, and it was 11 days to expiration. So based on our analysis, this closing bar, there is a staggering high probability that this stock is going to close above the $20 strike price way the heck down here within 11 days. When we sell a put, we're taking in money, and we have the obligation, if the put seller wants us to purchase 100 shares for every short put option of the stock on or before expiration. Well, they're not going to make us buy their stock as long as it stays above $20, because then it would be at a loss. And then we just bought the further out of the money puts to make this what's called a bull put credit spread. The difference of those two numbers was 50 cents, and this makes it less buying power requirement at the brokerage firm. Plus, for whatever reason, it had a disaster gap's down to 10 bucks for whatever reason, then we are reducing our potential maximum loss. We took in 50 cents a share, so if you sold 10 of these put credit spreads, $500 would immediately go into your account. This is the closed trades comments that we give to our subscribers, and we give them the symbol, the date, the technical setup, and the strategy, and a protective stop. So here it is, a positive gap breakout on increasing volume over this ugly red bar on earnings. That was the rationale for putting this in. As the stock started to move up, I just said, you know what, bid a nickel to get out. 5 days later, so we had 11 days of risk, and we booked 90% of the potential maximum gain. So of this 50 cents, of the $500, closing it at a nickel, we booked $450 in 5 days, which is a 10% return on capital. Hope that helps. See you in the next video.